Thank you for joining us. I'm Mark Epps. Please subscribe to my YouTube channel and follow me across all my social media channels at Mark Epps. Today we're joined by Mark Stemp, one of the country's leading tax advisors, to talk about the life cycle of residential lettings properties. That's the tax cycle, and you'll be focusing on income tax, corporation tax, tax reporting, capital gains tax and inheritance tax. Just taking us through the whole cycle from purchase to sale.
Yeah, no, thank you for inviting me along today. This sort of follows up from the conversation that we had sort of last year or so, where I went along to a Landlords event and we sort of spoke through those taxes at that time.
We've got another one coming up actually, which is for the Renters' Rights Bill, so that'll be a humdinger. We were a fully packed house, I think.
That's great.
Packed to the rafters to watch you, 120 people, I think.
Yeah.
So a very successful turnout. So you'll be refreshing what we know and bring us up to date with the various changes. So I think we'll start with acquiring a property, if that's okay with you, Mark. What trends are you seeing with tax structuring property acquisitions? Is the usual company versus personal ownership still the main comparisons that you do?
Yeah, so when someone's identified a property, one of the early conversations are who should buy it then. So should they buy it in their own name? Should they buy it with their partner or another family member? Or should they buy that with a company? And so it can be quite complicated working through which is the right approach. But in sort of broad terms, if you buy it yourself, you have to think about income tax because you'll be renting it out, you'll make a profit, you have to pay income tax on that profit. And income tax rate will depend on what your other income is. So you might be employed, you might have some other types of income that mean you're a higher rate or an additional rate taxpayer. We saw in the budget a couple of weeks ago that they're going to increase income tax on rental income, on property income. They're going to add an extra 2% on top of the normal rate for you. That comes in from April 2027.
How do you think that will affect things?
It makes it more expensive. So the government has introduced another increase in tax on landlords, and we've seen several of those over the years. You'll remember when we had the stamp duty land tax surcharge increase from 3% to 5%. Similar things happening with income tax here. So it's eating away at margins that little bit more. But what that will probably mean is landlords will need to charge more rent, and they'll end up passing some of those costs on to their tenants.
Sure.
So you've got, buy it yourself, got to think about income tax. If you buy it through a company, then you'll pay corporation tax on your profits. So you'll calculate your profits, those profits subject to corporation tax, and the maximum rate at the moment is at 25%. So you're sort of thinking, well, I've got personal tax at 40%. I've got corporate tax at 20%. Which one's cheaper? The corporate tax. The other thing just to bear in mind is that loan interest relief restriction. So as an individual, if I buy a property using money I've borrowed from the bank, I don't get as much tax relief. I can only get basic rate tax relief on that as an individual. So I'll do the comparison, and usually I'll end up with a company is probably going to be more efficient in the longer term because the tax rate's less. So that's the analysis that needs to happen. The thing about a company is it costs money to set one up. You've got to do corporation tax, you've got to think about sets of accounts every year. So there's actually an ongoing cost of having the company versus doing it yourself on your own self-assessment tax return or through making tax digital. And so you've got these two comparisons to bear in mind. So I always say to somebody, set the two out, do a cost benefit analysis to see which is most appropriate from a tax perspective. The last thing just to note is with the company, it's the company that makes the money. It doesn't go into your bank account for you to spend on whatever you spend your money on. The money ends up in the company bank account, and to get the money out of it, you've got to pay some dividend taxes. And so getting the money out, you'll pay an extra layer of tax. That extra layer of tax is subject to income tax on you, but you only pay on what you take out. So if you're paying down borrowings, you won't pay dividend taxes on what you're doing to repay some of that capital, those borrowings.
Would you say most landlords are set up correctly, or a lot of landlords would benefit from looking at their setup?
No, really good question. And it's a really common question that I get from people. generally speaking, people start out acquiring property themselves or with a partner. So basically they start out small, they're thinking I'll give property a go, we'll see what the returns look like. And then over the years, they build onto their portfolio, and so the portfolio grows bigger. So it probably was suitable at the beginning, owning it themselves, because it was quite a couple of properties. But as soon as the portfolio gets bigger, then corporates start to become more interesting and maybe the right way from a tax perspective to look at when you do that cost benefit analysis. So to answer your question, it's all around, they started off with the right structure, probably need to review the structure for the future, especially because we've got extra income tax due in 2027 and not the same corporation tax increase due. So yeah, repurposing, re-looking at it, making sure it's relevant is important.
So I think there'll be a lot of landlords also out there thinking, I don't really understand all this.
Yep.
That is the perfect time to speak to a tax advisor like you, I think, who can say, well, maybe you don't need to understand it, just do this.
Yeah, and it's really and my role is
you
to
can hold their
understand
hand through the whole thing and say, look, don't worry about it, this is what you should be doing.
Yeah, that's very true. And trying to make it really simple, make sure we understand what those numbers are, ask the right questions so that they can do what's the right thing for them.
Simplifying that must be a very difficult thing for you, I should imagine.
And they don't make it easier for me either.
With the changes that come along the way. Property incorporation.
Yep.
Have you seen much activity from clients who are choosing to switch from owning property in their own names to holding that property in a company?
Yeah, so lots of tax changes over the recent years, and including, we're just about to see some more changes come in, have meant that incorporating your property, so what we mean by that is you own it yourself and you think, I want to own it in a company. So moving it from yourself to a company, that's incorporating your property portfolio. And so you sort of do that cost benefit analysis we talked about before, work out whether a company is right, but if it's right, then you need to get all the property from your own name into the company. So it's quite a common thing as the property portfolio's got bigger over time. There's quite a lot of tax things to think about. And there's been quite a lot in the press, and also HMRC have done a lot of press releases about people that have done this and produced capital gains tax bills, and they've produced stamp duty land tax bills, but maybe at the time didn't report them or didn't think them through properly. So really important you get the right tax advice when you do incorporate to make sure you know what your tax bills are. There are some reliefs which can reduce those tax bills if you meet those criteria properly, but if you don't, then there's some tax issues getting into that corporate structure.
Capital gains tax.
That's selling property, that one.
When you presented us to us in June 2024, we had just seen a reduction in capital gains tax rate from 28 to 24%. There's talk about capital gains tax rates being aligned with income. Do you think that's likely to happen?
Yeah, so capital gains tax is when you sell a property.
Yeah.
So you make the decision that property is not for you for whatever reason, you'll trigger a capital gain. And the capital gains tax rate at the moment being 24%, and has been for the last couple of years now, is what people think is an okay tax rate compared to income tax, which could be at like 40 or 45%. Not for this budget, but the prior budget, so a year or so ago, there was some talk specifically around aligning capital gains tax rates with income tax rates. So everyone was thinking rates are going to go up quite significantly.
It was frightening.
It was, and people were deliberately triggering gains. So whether that was selling property, or alternatively some people were like gifting things to the next generation and triggering capital gains tax to pay the current rate and to do something called base cost uplift.
Yep.
So they were deliberately doing that. At the time, what happened from the Treasurer's perspective is sometimes if you increase tax rates, you make less money because fewer people trigger disposals. So it's getting that careful balance. And so yes, rates might go up slightly, but we've sort of got to that stage that if they increase them too much, they're just going to make less money. So I don't see them changing in the short term unless they need suddenly a big push, but then I think they'll probably go back to where they should be, which is at the current rate.
Can you remind me how capital gains tax is calculated on the sale of a property, and how do you go about reporting it to HMRC?
Yeah, so when you sell a property, you have to calculate your capital gain, and the capital gain for most people is the difference between what you sold it for and what you acquired it at. You make some adjustments for like selling fees and purchase fees, stamp duty, to work out what your real capital gain is. So you work out that number, you'll get a personal allowance. It's £3,000, called the annual exemption. Everyone gets £3,000 tax-free. Over and above that is your capital gains tax rate. There's two capital gains tax rates. It depends whether you're a basic rate or a higher rate taxpayer. For those higher rate taxpayers, the rate's at 24% that we just spoke about. So work out your tax bill. Once you've worked out your tax bill, you have to report it to the tax office. They've got some very short time periods to report to the tax office. So as soon as you've completed the transaction, that starts a 60-day window. So within 60 days, you've got to have reported your gain to the tax office, and you've got to have paid the tax.
And that had changed quite recently, I think.
Yeah, it used to be 30 days, but that wasn't quite long enough for everyone to get everything done. So they extended it to 60 days.
Gifting a property, I think this will be very interesting for a lot of people. Inheritance tax planning is often a question from landlords who know that a property in their name on death is likely to produce a tax bill of 40%. What are the tax implications if they choose to give the property to their child?
Yeah, so with this, when I talk to clients about this, they say this is a really good rental property. They're sort of deciding it's the right thing to keep hold of this property in the family because they're getting the right yields from it. They've identified something they want to keep hold of.
Yeah, of course.
So what they're basically saying is, right, I've got this property, I've decided that I don't need the income from this property anymore. I've decided what I'm going to do is pass it on to my adult child, because typically you'll do this later in life. Your child's probably grown up to an age where actually they're quite sensible at that particular point. So you'll give that property onto your child. So you make that gift. That gift is treated for capital gains tax purposes as a sale at market value. So that produces a capital gains tax bill, and we just described that capital gains tax bill. That could be a large bill if you've kept that property for a long period of time. But the benefit of doing this transaction is the value you've given away. Once you've survived that gift by 7 years, you're not paying inheritance tax on the value of the property. So you're saving tax at 40%, because the inheritance tax rates are 40%. Give it away, survive 7 years, no inheritance tax, but we've just got to be mindful of the capital gains tax.
I have heard that trusts can be a helpful way to pass property on. How does that work? I think that's changed quite considerably over the years, certainly since my time.
Yeah, so trusts are really helpful for two particular reasons. First of all, I mentioned that when you give the property direct to a child, there's a capital gains tax bill. If you give it to a trust for the benefit of the child and the children, you don't pay the capital gains tax. There's a special rule that says when you make the gift to the trust, you don't trigger that particular gain. You defer the gain until there's a sale of the property later. So it's a deferral mechanism, but it does mean you'd have to pay the capital gains tax up front, which is great. And the second benefit is around the fact that if you've got quite immature children, or children you're not quite trusting as much as maybe you would in the future, you can give that property, give it to the trust for the benefit of the children. The kids aren't going to do things with the property, it's not their property yet, but you're able to control that property as trustee.
Would that be a bare trust?
Yeah, there's lots of different types of trusts, but I generally use something called a discretionary trust, which basically means that the trust is set up for a group of potential people that may or may not get something in the future.
So it is still possible to set up trusts, and very useful.
Really relevant part of planning. There's just a limit on the trust allowance, and the maximum amount that you can put into a trust for an individual is only £325,000. For a married couple, that basically means £650,000 of assets can go into a trust. So using a trust allowance makes sense. But if you've got larger inheritance tax issues, it may well be you can only do a little bit with the trust. You've got to think about some other things from a planning perspective.
On the subject of families, family investment companies, some of our larger landlords have company structures that hold property as well as other investments in share portfolios. Do you often advise on setting up these type of structures? And if so, why are they tax efficient?
Yeah, so family investment companies are quite a significant part of planning, where you've got a number of properties and maybe you do have some other assets like a property portfolio. You sort of need to have a certain number of assets to make them worth doing. You wouldn't just put one property in and probably not do anything. You've sort of got to have a group of things together to make them efficient. So when I advise on those, we're looking at them to make sure they're inheritance tax efficient. So we think about, you've got a company, you've got to work out who the owner of the company is. So it may well be that the parents own the shares, and maybe we'll involve a trust or some of the children to share the asset value amongst members, so that it's not all in their estates for inheritance tax purposes. So we're able to pass that on to the next generation without paying inheritance tax on one of the adults that are to die. So it works for inheritance tax, and also you can do things from an income perspective. So if we think about the fact we've got some income in the company, that's been subject to corporation tax if it's rental profits, or if it's dividends, it's unlikely to be needed to be taxed. We can then distribute that out for maybe school fees, university fees, or the like, and we can share that income amongst the family, which basically means it's not all in one person's name paying high rates of tax.
A few other things that aren't strictly part of the presentation. Inheritance tax has been featured a lot in the press, with the farmers getting particularly frustrated about the changes to the IHT rules on their businesses. What are the farmers frustrated about?
Yeah, so
I don't fully understand it, I have to be honest.
No, but they're quite frustrated.
I understand that.
Yeah, so what's been reported in the press is the fact that inheritance tax is changing for business owners. So whether you're a farmer, whether you run a trading business, at the moment businesses, when you die, you don't pay inheritance tax on them. We're talking about a type of business which is something called a trading business. That's different to investment businesses. So portfolios in companies are investments, but if you run your own business, so if you've got a trading business, these changes are going to impact you. And so at the moment, what happens is if you die and you get something called business property relief or agricultural property relief, there's no inheritance tax passing your business, your trading business, onto the next generation. So that basically means you don't have to worry about planning too much, get your will in the right place, make sure the right people inherit your business, but if you die, no inheritance tax to pay on the value of that business, so long as it's the right type of trading business. Rules are changing in April, and in April what's happening is they're saying the first £1 million of your business can be passed on tax-free. Anything over and above £1 million, there's now going to be a tax bill. And so before it was zero tax, now for some businesses that's a big number. They're going to have to pay inheritance tax. You get something called 50% relief, so that means a 20% inheritance tax rate.
Right.
But before that, didn't have to find the money to pay the tax. Now they're going to have to find the money to pay the tax. And so the frustration is around the fact that they're passing on business to the next generation.
Who can't afford it?
There's no money to do that.
Can't pass the business on.
And certainly with farmers, they don't have much income.
So
returns on
wow.
farms are quite difficult.
There was recently a new mansion tax announced for property over 2 million. Do you know how that is planned to work?
Yeah, so in 2026, the valuation office is going to value property. And so they're going to be advising property owners on the value of the property for this, what they've called council tax. But typically council tax is payable by the occupiers of property. For landlords, maybe if they've got an HMO, they may be over the 2 million limit. It's actually the owners of the property that pay this surcharge. And so they introduced in the budget, depending on how much the property is worth, will depend on how much that you pay with regards to your extra council tax for owning that particular property. So there's some big changes coming. That money you'll pay to the local authority, the person that collects the council tax, but they're accountable to central government. And so there's a big task around valuations, and the district valuer is going to be very busy working those through, and every 5 years they'll get revalued.
We have just done a separate video on making tax digital with a software provider, Hammock, who are very good. We recommend them. You recommend them as well. In fact, you use them, don't you?
That's right.
It was a great video, so if that is of interest, and it should be because it's hurtling your way, I think, isn't it?
That's right.
then keep your eyes open for that. A very, very good video, and I can't recommend Hammock highly enough. Just briefly, I think, if people haven't got access to that video, what is making tax making tax digital, and when's that coming in?
Yeah, so Making Tax Digital is being introduced from April 26 for landlords and self-employed people. So these are people that have got income. So we're not talking about profit, but their rental income or their income from their self-employment is more than £50,000. So it's over £50,000. They'll be required to change their reporting to the tax office. So at the moment they do self-assessment tax returns. From April 26 they'll be required to do quarterly submissions, submitting income, submitting expenses to the tax office every quarter. And then at the same time they normally do their tax return, they'll have to do a final submission at that particular point in time, declaring all of their income for the whole of the tax year, but it's the normal payment dates. This is just all around changing to quarterly rather than doing one return.
And I think it's all a good thing. I think that was the big takeaway from it. And the software system provides a whole sphere of knowledge on top, doesn't it? Profitability, yield and everything else. So a great thing to get stuck into, and it just makes your life easier as a landlord and makes life easier for HMRC and stops overpayments, underpayments. You know exactly where you are, so there are no nasty surprises along the way, or at least in theory anyway.
Right.
Mark, I think that was absolutely fantastic. Thank you so much. And I think the big takeaway from this, if you are a landlord and you're worried about your tax setup, you really should be talking to a tax expert like Mark, and we'll drop Mark's details in the description below. But thank you very much, Mark, and while you're here, please take time to subscribe to my YouTube channel at Mark Epps, and I'm at Mark Epps across all social media channels. Mark, thank you very much.